Hi, everybody. This is Alan Elman, the Blue Collar Investor. In this video, we're going to discuss how to set up a covered call trade, the actual step-by-step process. We're going to be using a real-life example with Tenet Healthcare Corp., which is listed on the New York Stock Exchange under the ticker symbol THC. Let's get started. So first, let's go through an overview of what I'd like to accomplish in this video. We're going to talk about stock selection and some of the rationale behind it. Then we'll move into option selection and some of the rationale behind that as well. We'll do some initial pre-trade calculations, which will assist us in making our trading decisions. And finally, once we've made our decision, we'll actually show you the trade entries and actual initial trade calculations. Here we go. Now, one of the main resources offered by BCI to its premium members are its watch lists for eligible option trading candidates, both stocks and exchange traded funds. In this screenshot now, you're looking a little snippet from the BCI Premium Stock Report, and that's where I got THC from. So as you can see, I highlighted that row in pink. So Tenet Healthcare at the time was trading at 162.41, was in the medical industry segment, and that segment had a ranking of A. It also had a mean analyst rating of 1.43, which was outstanding based on a 1 through 5 range, 1 being the best. The on-balance volume, that's an institutional component showing money going into it on up days versus against it on down days, and that was a bullish signal regarding on-balance volume. You can see here that the implied volatility was over 29, which is pretty robust. And the earnings report date was 10/23. Actually, this security at the time that I made this screenshot had been on our watch list for 16 weeks, 4 months. So it's been quite a good performer for members of the BCI community. Now, those of you who are premium members know that we also offer additional resources from which you could make your selections, both stocks and exchange traded funds. On this screenshot here, we're showing you on the left side our blue chip report of the best performing Dow 30 stocks. And on the right, we're showing you a little snippet of one of our exchange traded fund reports. So the ETF reports and the stock reports you saw on the last screenshot comes out weekly, and the blue chip report for the best performing Dow 30 stocks comes out once a month. Okay, so that's the stock selection, and it's based on both fundamentals and price performance, along with some common sense principles like avoiding earnings reports, diversification, and cash allocation. And all that material is in my videos and in my books, and I'll just briefly mention those at the end of this video. Now let's move on to the option chain. At the time that we're deciding whether or not we're going to use THC in our portfolio, and this screenshot was taken on September 20th, 24. And at the time, THC was trading at 166.75. So we could look at an in-the-money 160 strike, a defensive approach, or an out-of-the-money 170 strike, a more aggressive approach. And you can see here that at the time, will change a little bit when we actually ready to trade. The 160 in-the-money strike had a bid price of $10. And the out-of-the-money 170 price had a bid price of $4.20. So let's do our initial pre-trade calculations, which will assist us in making our trade decisions. So on the top row, both top and bottom segments, we're going to look at the 170 out-of-the-money strike. And in the bottom, in the second row in each half, we're going to look at the in-the-money 160 strike. Let's start with the out-of-the-money strike first, which is the one that I chose. Okay, so the out-of-the-money 170 strike had a bid price of $4.20. At the time, again, THC was trading at 166.75. So that's the entry for the out of the money strike. Now the calculations done by the trade management calculator spreadsheet tells us that it will be a 29-day trade if taken through contract expiration. And in the brown cells, it will give us an initial 29-day return of 2.52% that annualizes out to 31.7%. Now, because it's an out of the money strike, we have the opportunity for an additional 1.95%, meaning we can get about a 4.5% 29-day return using this out of the money strike. And that's for normal and bull market environments. Now let's look at the 160 in the money strike, which had a bid price of $10. Looking at the second row at the bottom here, we could see that that resulted in a 29-day return of 2.03% that annualized out to over 25%. Now, you look in the pink cell all the way to the right, and that tells us that we have downside protection of 4.05%. That means we are guaranteed a 2.03% 29-day return as long as share value does not decline by more than 4.05%. And that's different than the break-even price point of $156.75. That will give us much greater downside protection to the break-even price point. But I'm not interested in breaking even. I'm interested in generating cash flow. And that tells us, once again, that we are guaranteed that 2.03% for selling the in-the-money 160 call as long as it doesn't drop in price by 4.05%. So that gives us an idea of using the in the money and the out of the money strikes. Now I decided to use the out of the money 170 call, and I used some of the cash available in one of my portfolios to actually purchase 100 shares of THC. So let's move on now. I purchased 100 shares of THC and then I sold the call. So you're looking at a screenshot now of how I set up selling the covered call. So what are the strategy we're using when we go into options? We're using calls and sell to open. It's one contract since I bought 100 shares, and we set a limit order at 380. The bid is 370 and the ask is $4. So I went a little bit higher and I tried 380. The contract expiration was 10/18. Okay, so a little less than a month out. And once again, here's the 170 call. So that's the entry. It's a day trade, day only trade. And the limit order, once again, is 380. So how'd we do? We got filled. We bought 100 shares of THC, and this is a direct screenshot from one of my brokerage accounts. We bought it at 165.44, and we then sold the 170 out of the money call, and we did get the 380. That was the limit order that we requested, and we got it. Okay, now, after we enter the trade, we then use our 20%, 10% guidelines. In this case, since it's nearly a month out, we set a buy to close, good until canceled limit order to buy back the option at 20% of 380. Remember, we got 380, and that's 76 cents. So we enter a limit order, but this one is good until cancel, okay? Because that stays there until we change it. And if the price of THC drops, causing the value of the premium to drop to 20% or less than what we generated, the broker will automatically buy back that option, and then we can determine what our next step is going to be. We have several choices, and that again is in the material I'll be mentioning at the end. But this is a screenshot of the actual buy to close, good until canceled limit order based on the 20% guideline. All right, now let's take a look at our actual initial trade calculations before we did the pre-trade calculations to make our trading decisions. So here we go. We bought THC at 165.44. We decided on the 170 out of the money call, which generated 380. Once again, the spreadsheet tells us, yes, it's still a 29-day trade. Nothing changed there. And the return was 2.3%, about what it was pre-trade. And that annualized out to nearly 29%. We have an opportunity for an additional 2.76%, which means we can get nearly, actually a little bit over a 5% 29-day return if THC moves from its current market value of 165.44 to or beyond that 170 out of the money strike. So it's a great opportunity to generate a very, very high return in this 29-day trade. Now, remember, we also have a 20% buy to close, good till cancel limit order in place to help protect us from share price decline. So let's summarize now. Covered call writing trades are represented by a three-step process. Number one, stock or ETF selection. And I showed you the three reports of eligible candidates we offer our premium members. Second, option selection. What strike and what expiration date? Are we going to go in the money or out of the money? Are we going to be defensive or more aggressive? And then finally, position management. I showed you the first step to that with the 20%, 10% guideline entries. Now, what are our trading decisions based on? First of all, what is our overall market assessment? If it's bearish and volatile, well, we might go with that in the money strike, and vice versa. What about our personal risk tolerance? Well, if we use very, very volatile stocks, then we're taking more risk. My goal is 2 to 4% a month, which will tell us the implied volatility is within a certain range, because the implied volatility of the underlying securities is directly related to the premium returns. So for me, it's 2 to 4% a month. In my mom's portfolio, I use 1 to 2%, a little more conservative. What's right for you? Only you can determine that. Okay, as promised, I'm just going to briefly mention the products and tools that we offer to master these strategies. If you go to the bluecollarinvestor.com, right to the right of the membership link is our store. And if you click on best packages, you will have opportunities to get the best discounted packages that we offer. The main package is our BCI, which is an acronym for our best and most comprehensive investment package. It has 18 components, folks, 6 online video courses with downloadable workbooks, 6 spreadsheets developed by the blue collar investor, found nowhere else, and 5 of our bestsellers in books in ebook format. And mainly our 13-month premium membership, which consists of the reports I mentioned to you before, plus an additional high dividend yield report, over 250 training videos, and dozens of downloads and resources. The second of our best discounted packages is our Trade Management Calculator package. You already saw a little bit of that in action in this video. There's much more to it. It is an absolute must if you're using covered call writing or selling cash secured puts. It also comes with our 28-page user guide and the PDF version of my 8th book, Exit Strategies for Covered Call Writing and Selling Cash Secured Puts. That's 27 chapters of exit strategy information. The third of our best discounted packages is our CEO package, an acronym for combining exchange-traded funds with stock options. It's a streamlined approach to covered call writing for those of us with busy schedules. It includes 2 spreadsheets developed by the blue collar investor, along with the PDF version of my 9th book, Covered Call Writing, a Streamlined Approach. Now, under the CEO products, you can also include the BCI and TMC packages all together, and that is everything BCI has to offer. Or you can go to our store and build your own toolkit and get items individually, books, spreadsheets, videos, and so on individually. So ladies and gentlemen, that ends this video, how to set up a covered call trade, step-by-step process. Folks, I hope you enjoyed this presentation, but most importantly, I hope you benefit from it. As always, this is Alan Ellman, the Blue Collar Investor. Take care, everybody.